So, Mona, I'm going to start with you. Please tell us a bit about Avantgarde and how you're bridging institutional capital, institutional investors, and the DeFi protocols.
Yeah, so, oh, sorry. Hello? Is this working? Yeah, so the backstory to Avantgarde is
That's okay. You're good. You're good. Just keep it close.
I founded a DeFi protocol 7 years ago. We built an on-chain asset management protocol using blockchain smart contracts, which completely automated the operational and administrative side of asset management. Avantgarde was founded 3 years ago, also by me. But this time we're building an institutional grade layer on top of it to help bring DeFi compliantly to institutions. And the premise of what we do is ensuring maximum transparency, eliminating counterparty risk, and enabling investors to have the option of self-custody, not the obligation.
I'm going to jump to Harry because I want to be provocative. Harry.
Hi.
Harry Ye does a lot, but we're here to talk about life. And,
yes.
Mona just mentioned DeFi and compliance. Do those two need to be together?
So should I introduce myself first, or
and
we answer
introduce
the question?
Yourself, yeah.
Okay, so which one should I do first?
Let's mix it up. Answer the question.
Okay, I'll answer the question. So could you repeat the question?
Yeah. So the question is, Mona talks about the intersection of DeFi and compliance. So it's a little bit facetious, but obviously there has to be an element of compliance. But is compliance a primary factor in building success in DeFi protocols?
Ooh, that's a good question, because DeFi is really, really focused more on anonymity. So I don't think compliance for the anonymous protocols is as important, but for our protocol specifically, we don't KYC, but on our permission, we have a permission chain that we're launching for layer 1, where there is a developer program where you have to be kind of KYC'd or at least be a developer, so you can't just deploy random smart contracts on the platform. So I think it really depends on what you're doing. In terms of, compliance for money transfer, that's always kind of a subject of debate, I guess, because you've got, on one hand, people that want privacy, but then you also want to kind of eliminate, the possibility of terrorist financing. So I think the question is, it really depends and kind of where you're located.
Okay, let's talk about what you're doing.
Sure, so my name's Harry Ye. I'm managing director and founder of Quantum Fintech Group. We're a quant and asymmetric return hedge fund strategy, so we typically focus on steady yield farming. But if we suspect the bull market is in full effect, we'll kind of hyper-focus on 1 or 2 projects and just really put all of our energy into making sure that these projects succeed. In the previous bull market cycle, our 2 most successful projects were Phantom and Tomb. And that kind of leads me to the next point, is after the crash of the Terra Luna thing, we had an opportunity to really kind of build something from scratch. So we built a project called Life, and I think most of you have registered for the Enjoy Life party, and that's Life with the number 3. So our protocol is really, really kind of a vertical DeFi ecosystem for yield farming. So we've got an 8-year plan for a DeFi earning and safety, but we're also building an entire ecosystem, such as a permission layer 1, and layer 2 is a service on top of our layer 1.
And I've been to one of his parties, so if you're going tonight, get a late checkout tomorrow, and you should be fine.
Thank you. You're always invited.
Thank you. Olga, you're the opposite extreme. You have a centralized exchange, publicly listed on the NASDAQ. What are you doing here?
Well, that's
no, so tell us a bit about Smart Valor and how you see the intersection of CeFi and DeFi over time.
Yeah, guys, I've been in crypto for 10 years. We've done a lot of different things. Actually, it's funny. We started Smart Valor as a decentralized marketplace for tokenized securities. Right? That was 2017. Mm-hmm. And you can guess 3 times what happened, right? We thought we can change the regulation, that tokenized securities and DEXs will be possible in 2018. Guess what? Didn't work out. So we pivoted into
don't
trading.
Complain, you didn't get a Wells notice.
It's okay. So we pivoted into being just an exchange for, tokens and crypto assets, right? Mm-hmm. And today we have 2 businesses. So one is basically, crypto exchange for retail. So I like to call us Coinbase of Switzerland. And the other business is B2B, where we provide technology, staking, trading, everything for banks, and basically B2B. So enabling other Fintech and banks give digital assets to their customers. That's in a nutshell.
Understood. Okay. Pat, you're kind of on the, first of all, Pat, LaVecchia, D'Agostino, the Italians bookend, right? Here we go, represent. There's very few of us that aren't cleaning up after, right? So, good job. So you kind of bridge this gap. Oasis kind of sits in between the two, and you and I have a very similar background. You know, the idea of listed and OTC, effectively DeFi, not off-exchange activity, that's historically exists in the commodities markets, where I was head of strategy for the New York Mercantile Exchange. The OTC derivative market dwarfed the listed derivative market by 10x, 20x. So these concepts aren't new. How do you see that interplay playing out in crypto over time?
So crypto or DeFi, I view DeFi differently in real-world assets.
Explain the difference.
So just quick background, we're a global fintech company. We are focused, we have a DeFi advisory platform or a subsidiary, and we also have a broker-dealer in the US, and we have an ATS, which is exchange light in the US, and our focus is digital asset securities. So in regards to what we do at the end of the day, we're really about the blockchain, utilizing certain cryptos, like we're actually approved to transact, not trade, but transact stablecoins, CBDCs, Bitcoin and ETH for digital securities. So we can do an atomic swap today. Now, our genesis actually, I'm a banker long time, 25 plus years, Credit Suisse, Bear Stearns, and others, and I became part of MakerDAO, and for those who don't know in the room, MakerDAO is really the granddaddy of DeFi, and it's basically collateralization of crypto moving into collateralization of real-world assets. And the interesting thing for us is, and it's going to take some time. I think it's 3 to 5 years, but our focus is entirely institutional. And what we're doing there is focused on becoming the blockchain vertical with major money center banks and others in regards to transact for these digital asset securities. We plan on incorporating DeFi into that, and we'll talk a bit about that a little later in regards to pooling opportunities with Uniswap, maybe MakerDAO as a collateralization platform, and some other components. But that's our area. So we're, today I'm going to talk about our institutional and our DeFi subsidiaries, and where the world is going in terms of utilizing blockchain, which is an amazing technology for the future of structured products, trade finance. There are just so many uses.
So Mona, Pat's trying to attract institutional investors to DeFi. We've had some scaling issues. There hasn't been mass adoption. I mean, TVL is down a fair amount. Is that driven by faults in the technology? Is it driven by concerns over centralized failures? What do you think's stopping adoption? Slowing adoption, I should say.
I think I don't think it's liquidity, actually. I think it's more the compliance side. Like when we speak to institutions, a large part of them are like, we're fully regulated, we can't touch DeFi, or we have very high restrictions. On the liquidity side, for example, we don't, we are an asset, we're asset management firm. Asset management is obviously, active asset management is very highly regulated, whether it's DeFi or not. So there is no way that a regulated SEC asset manager is going to run a DeFi fund in a completely anonymous way without knowing their counterparty trades and without knowing who their investors are. So what we've done is Avantgarde has built a layer on top of the protocol where you can know that, you can know all of that stuff, and you can have an institutional grade DeFi business. With institutional grade security, with institutional grade transparency and reporting, actually better, frankly. It's important to remember DeFi doesn't change the what in finance. Everything we've seen in DeFi, we've seen in traditional finance. It's the same thing: lending, borrowing, derivatives, perpetuals, etc. It's the how that's really important. And what we've really done in DeFi is eliminate counterparty risk, enable market participants to have full-time transparency, immediate settlement, and the option for self-custody. And I think this is revolutionary. I think it's not all, you can still have centralized market makers settling on decentralized exchanges. Mm-hmm. So this is like something that we actually connect market makers in the centralized world, but we force them to settle in a kind of autonomous transaction. So I think it's really like bridging these two worlds is much more about figuring out the compliance than the liquidity.
So Harry, it almost sounds like it sounds like this is going to bifurcate between, I'll call it a lit and a dark market, where, not to assign negativity to anything, but a dark market being an anonymous market, a lit market being an identified market. So first of all, is that fair? And secondly, I'm going to assume it's fair, but who can participate in the dark market? Who can participate in the anonymized market? Because Mona's saying regulated institutions have to know who their counterparties are. So if you're building the other side of that, who are your participants?
Well, I think first you probably want to have clarity. Dark is illegal, so we don't participate.
Yeah, it's a bad word, but the idea of anonymized versus non-anonymized.
Yeah, sure. So I think, well, blockchain technically is not truly anonymous. It's always pseudo-anonymous. Right. If you can trace the source of the genesis of an address, and that address goes to a centralized exchange at some point, it's pretty easy to be able to identify a person. So I think right now, at least for me, what we're focused on is really, how do you make money? Because this is why we're in the game in the first place, right? How do I get that 200% yield? How do I get that, 30x return? That's what we focus on. So we focus on really, really building good products and long sustainable life for a DeFi project. So for example, our protocol is really focused on how do you build a successful DeFi protocol over an 8-year period versus, hey, we're here today, gone tomorrow. So it's going to attract, it allows people that are, I believe people should be anonymous in some ways. There's some level of privacy where anybody can kind of participate. But I think now, at least in the US, a lot of DeFi projects are shying away from even people in the US because they want to regulate, DeFi in the US for, what is it, tax purposes probably. We're not in the US, we're in the UAE, so a lot of the rules that apply to traditional, I guess, funds or projects that are based out of the US don't really necessarily apply because we kind of geofence. So I think, yeah, everybody should have the whole point of Bitcoin and crypto was everybody on earth should have a God-given right to manage and control their own money. So we're not, thank you, we're not here to kind of stop that, but we want to provide more of that. We're not kind of far left on regulation and no regulation. We're not far right regulated everything. We're kind of in the middle where it's like, fine, stop fraud, eliminate rugs. And this is what we're really, really focused on building. We're focused on what we can do, not what we can't control. Does that make sense?
So I'm guessing you're not a big fan of CBDCs.
I can't say I'm a fan nor a fan. I just like to see it happen.
Okay.
Sure, why not? Because it just validates the technology. That's all it is. Central bank digital currencies, bring them on.
Okay. Olga, do centralized exchanges have a reputational hurdle to claw back from? How bad is FTX? How bad are these situations? Or not? I mean, because I'll note this. So FTX catastrophic, although it was announced yesterday, about 7.3 of the roughly $8.5 billion of value loss has been recovered. So ultimately, 80 cents in the dollar, which is not that bad. I'll note that in the same year that FTX failed, the London Metals Exchange canceled $20 billion of nickel trades in one day, and nobody said a word. Nobody's running around screaming and yelling that commodity contracts are useless and the entire market's breaking down. It was $20 billion of value wiped out because they mismanaged risk, and they realized if they allowed them to settle, the entire exchange would bankrupt. So, there's an argument to be made that people are too hard on crypto when these failures occur.
Crypto's sexier. Metals are not. They don't cause news.
But Harry, in fairness, we make it easy. I mean, there's a lot of personalities that you want to punch in the face.
That is true.
Right? Let's be honest. We're an easy target. But Olga, where do we stand now? Is there a hurdle to overcome, or do you think that we're past that?
Well, I can tell you from first-hand experience, the existence of centralized exchange has never been so hard as in the last 5 months, right? Okay. After FTX happened. I can tell you how many interview requests I received from journalists, and they are like, oh, this is so bad with FTX. We just want to know what happened. Can you explain this to us? And then you explain this to them. And the next thing you know, they put a title in newspaper where they say that you're in trouble. So it's disaster, guys, right? And I've been in crypto for 10 years, run other companies and so on, but it's never been so bad, right?
So how do we make it better? What
how
needs
do
to be
we
done?
make it better? Well, our answer was kind of like, voluntarily submitting ourselves to the highest requirements you can find, right? Become NASDAQ publicly listed company, right? You're subject to so many rules. The, NASDAQ rule book is, I guess, like something like 160 pages, right? Audited financial statements. We do quarterly financial statements. We do board of directors, governance, like all of this stuff. It's crazy, And for a relatively small company, like that's almost overkill, right? But that was our answer. We want to show to our partners, to banks, especially in the view of our B2B strategy, right? We want to show them that crypto can be done right.
I don't think the industry actually has to do anything. Just more banks have to fail. That's it.
Now,
just more banks have to fail. That's it for crypto to succeed. No joke.
Eventually there'll be no choice. But,
That's
Pat,
it.
Pat, you want to
so I was just going to say the last 5 months have been fantastic for us because we're regulatory and compliance forward. And in the U.S., digital asset securities, Gary Gensler, who a lot of people don't like in regards to his approach, is regulating by enforcement, and everything we do is KYC, AML. And what I've seen with the FTX debacle, and we knew the FTX folks well. We know a lot of the folks out there. We've been doing this for a bit, and the movement has been away from Bitcoin and ETH, which in the U.S. the CFTC has come out and basically stated are commodities and under their purview, not staked ETH. Staked ETH is most likely going to be a security. But for the most part, the trend is these are securities, KYC, AML, counterparties, everything that's been around for like 30, 40 years.
To be clear, it's a trend in the U.S.
This is the U.S.
US trend.
Yeah.
The MiCA rule in Europe goes so far as to say they're not all securities. UAE certainly is saying, looking case by case. There's nowhere in the world except the U.S.
Absolutely. And we're partnering. Yes and no, because I'm a student of financial history. I'm a banker for 25 plus years. Everything is usually coordinated amongst the major countries. FinCEN in the US, the EU, and a whole host of others.
That's right, yeah.
So I think at the end of the day, the UAE is doing tremendous things. We're looking to partner in Singapore, UAE, Switzerland. We have a subsidiary, the UK, and the rest of the EU right now. So we're more than happy to go down the process of whatever the local provisional regulations are. But again, I might be wrong, and I was deep in DeFi and OG, but I think at the end game here is KYC, AML, and we haven't talked about DeFi and deeply in terms of capital markets, but collateralization. Quick example, I think this might be helpful. You have a security, right? A real estate building. It's tokenized, it's a security. It just sits there. With an ATS, it'll be able to trade, right? Maybe fractionally. But it gets really cool when you get it approved to be a collateral in the MakerDAO ecosystem, and there are others out there too. Yep. So instead of selling, what you can do is you can borrow against it because there's a mark-to-market on the ATS. That's where an opportunity to utilize DeFi for real-world assets. Right. You can't use oracles, but you have an actual trading market in the event that the price drops and it needs to be liquidated.
I want to make sure we give Mona a fair time. So you're hearing one of the solutions that he's talking about, Pat's talking about vis-a-vis killer app or killer solution for DeFi transactions. Is that what's driving? Are those types of transactions are what's driving institutional investors towards your platform?
I think actually what's driving investors towards DeFi in general is twofold.
Okay.
The first is actually FTX. What is the reaction to FTX and the likes? The reaction is like, I can't trust anything custodial anymore, and I don't want to have counterparty risk, right? And the only solution to that problem, or the only way you recover trust from that, is more DeFi, not less, because DeFi eliminates counterparty risk, and it gives you the possibility of self-custody, while still accessing the same type of financial instruments.
Well, we did have a bridge hack per day.
Yes, that's true. But we now probably have half a dozen to a dozen protocols which are going on 4 years of a track record without a hack. Okay? So the second thing, and I think something that nobody is talking about anywhere at the moment because maybe it's a bit controversial, But we are living an era of being unbanked. I'm not just talking crypto, right? If you are Russian, right, you have been unbanked, not necessarily because you personally did something wrong. If you are doing something...
If you're rich, you can't get banked.
If you are now a crypto company, you're being unbanked. What's next, right? Again, the only way to protect against that is self-custody and being the one to unbank yourself. And again, the only solution to that is crypto and DeFi. So I think that is the answer. Well, thank you.
But you started off, for retail, I don't have an opinion, but you started off with something I agree with. Institutional investors cannot self-custody. At least the US and Europe both have qualified custody rules, so it's non-tenable. If I'm a registered hedge fund in Cayman, Guernsey, Dubai, Monaco, I cannot self-custody. So are you saying that those rules you think might change, or how will an institutional investor be comfortable breaching the qualified custody rule?
Yeah, I think that's something that a lot of institutions are trying to figure out, and that's why I keep saying it should be an option, not an obligation to start with.
Okay.
So although our funds will have fund tokens which are redeemable for the underlying crypto assets, we don't force you to hold self-custody, and we have partnered with qualified custodians. But I strongly encourage anybody who is getting involved in crypto, you know, when you're thinking about diversification, you really should be thinking, I'm not against centralized finance, but I think true diversification is having a portfolio that is a balance between centralized and decentralized, and having, you know, exposure to two different types of risk. In DeFi, your risk is, like you said, smart contracts, although we're building fairly decent track records by now in some protocols. And in centralized finance, your risks are being unbanked or being censored or just being shut down.
Who in that, raise your hand if you'd be comfortable keeping a substantial portion, you define what substantial is, of your wealth in a self-custodial solution. Raise your hand if you feel comfortable with that. Okay. The rest of you, I assume, are not. Raise your hand if you wouldn't feel comfortable with that. Nobody would feel uncomfortable with holding a liars. No, okay.
You have a centralized exchange, of course.
Absolutely right.
She is the custodian.
Because here, let me end with that. I'll let you opine on this. See, self-custody versus not. Self-custody is not a new concept. You can 100 years. You can buy diamonds and stick them under your mattress. We don't do that. Most people don't do that. So why suddenly, with an even more complicated solution than sticking diamonds under your mattress, are we suddenly going to feel very comfortable with this notion of keeping all of our wealth on a laminated piece of paper, on a ledger that maybe you know how to use because you're smart? But I would ask everybody here who said they would self-custody, can you name 3 people that, God forbid you were to pass away, you would trust with the technical ability and trustworthiness to take care of your estate?
Guys, I can tell you,
So,
I
you
grew
start.
up in Ukraine, right?
You start.
And in
Okay.
Ukraine, yes, you have banking, but this banking doesn't give you anything, right?
Okay.
So it's not like universal questions. This question is answered for different group of people in a different way. People in the countries like Ukraine and money is from Middle East, right? So there are a lot of countries, and this is a majority of populations. They don't have access to banking. There is no certainty and security in their institutions. There, you're better off with a self-custody.
It's a fair point.
For
I
us
may be
here,
spoiled.
like, guys, I don't worry about my, local bank little in Switzerland. I know they're not going to run away with my money, right? So it's different answer to where you sit, where you are in the world.
Okay. I'm going to end with you, because you Pat. What's your view on this?
So we're approved in the U.S. for custodial, so qualified custodians like banks and trust companies. But we're going down the process for self-custodial wallets as well, which in the U.S. is called and working with MetaMask Institutional and others in the event that the major institutions, and we are institutionally focused, feel comfortable holding their own wallets, self-custodial. So I think there's going to be an opportunity for both at the end of the day. The SEC did establish a self-custodial wallet path. It's called the 4-step process, and we're going down that path right now. Okay. The issue is we are not able, where I want to be is you have a self-custodial wallet, I have a custodial, I have a bank, and we can trade with each other. Okay. Right now, that's not in the regulations.
Harry? You want to opine on self-custody versus Do you think the average person, 5, 10, 20 years from now, the average person is going to feel comfortable self-custodying a meaningful part of their wealth?
Yes, I think it's more of an education rather than a technical hurdle. So for example, if people just understood how to do key splitting or use like, I think Shamir, it's just better education on how to properly store, self-custody. That hasn't really been kind of out there. We try to educate people on how to do this.
Okay.
So I think it's really, really more of an education. It's not difficult to self-custody, but custody solutions, of course, they're going to sell you fear because that's how they make money.
Yeah, that's
Right,
fair.
so.
Mona, final word?
Yeah, I do. I mean, we've been doing it for years anyway when it comes to gold and diamonds, like you said, and this is just like, a ledger or a private key is somewhat a bit more practical in the sense it travels easier and doesn't take up as much space.
Just remember it. It's so easy. 24 words. Come on.
Anyway, this has been great. Thank you so much. Everyone, please, round of applause.
Thank you, John.
Thank you.